Ladies and gents, traders and investors, a very warm welcome to our channel Polo Vega. On today's video, we shall explore the structure of a two-legged to three-legged to a four-legged option strategy. We've been talking about all kinds of option strategies in the past 1 to 1.5 months and have explored almost each and every kind of option strategy that helps traders and investors in the market to make the best profit at the lowest possible risk. But on today's video presentation, we shall look at the leg that brings in the profit for the trade and the leg that just restricts or limits the risk from a trade without participating in the profitability of the trade. But before we move on to the exploration of the structures of different kinds of option strategies, we shall first look at the events from the week that has gone by and the changes in the volatility of the markets and the changes in the environment in which the market has operated during the last 1 week. There has been a difference in how the traders and investors have been looking at the market during the past few weeks, ever since the commencement of the US-Iran war and the change that has occurred after the announcement of the peace deal between the United States of America and Iran. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 47th of a series of interactive videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment trading is a highly risky business and there exists a possibility of partial or total loss of investment. The ideas and opinions in our video are solely based on our analysis of the market, and we do not advise, recommend, guide anyone to take any trades based on the contents of the video. And we do not take any responsibility for partial or total losses arising out of trades based on the contents of the video. The chart on our screen is that of Dixie, the US dollar index, and we're looking at the daily chart. Dixie has managed to break out of its upper bound at 100.391, which it had maintained since April 2025, when it dropped from the supply area between 101.077 and 101.88 all the way to 98.898, and then it managed to drop further till it started trading sideways between its lower boundary at 95.00 and upper boundary at 100.391. We've now got a supply between 101.077 and 101.88 in play as of now, and we need to wait and see if the current strength in Dixie can take out this supply as well. This strength has been prompted by the move from the Fed Chair Walsh on Wednesday, when they kept the interest rates steady, and the new strategy from the Fed is that of no dot plot display to the market or to the trade magazines. This is going to allow the markets to assimilate the information from the environment on their own and then process it on their own without any help from the Fed. So one needs to wait and see if the dollar strength continues on the back of the suspense kept by the Fed as announced by Chair Walsh. The chart on our screen is that of Nasdaq, based ETF, the NQ, and we're looking at the daily chart. NQ has been going sideways during last 1 week after two significant announcements. The first one being the peace deal between United States of America and Iran, and the second one was the Fed meeting announcement on Wednesday when they decided to keep the rates as they were and also did not release the dot plot for the market to estimate the future strength or weakness in dollar. The suspense maintained by the Fed has now pushed the onus of collecting and assimilating all the information from the market environment and then deciding for themselves over the strength in dollar and related asset classes by themselves. So one needs to see if there are further changes or further surprises made by the Fed chair Wash in the future months, which would allow the market to process all the information by themselves rather than being guided by the information released by the Fed. The chart on our screen is that of XAU/USD, which is the gold-based ETF, and we're looking at the daily chart. Gold have managed to come back after hitting its low at 4022 during last week, and then the peace deal announcement from the United States and Iran managed to push it all the way to its high during last week of 4372, which was a very short-lived strength. And as soon as the Fed announced that they would keep the rates steady and their hawkish behavior prompted the gold-based ETF to drop all the way to 4128 on Friday, and it closed at 4161 at the close on Friday night. Now one needs to see if it continues to drop further under the renewed strength of the dollar provided by the hawkish behavior from Fed and also the hawkish behavior from the Bank of England on Thursday. So one needs to see if the rise in inflation prompts the central banks to maintain their hawkish stance for an extended period of time, or do they try to come back with a rate cut decision anyway towards the end of the year. But as of now, with the renewed strength in all the currencies, the metal has been bearish and it'll take some time for the bulls to come back and take charge. The chart on our screen is that of US oil spot, and we're looking at the daily chart. The US oil has had some massive drops during last 1 week after the announcement of the peace deal between United States of America and Iran. It has dropped all the way from 85 to touch the low of 72.9 and then finally close at 76.5 on Friday last week. One needs to wait and see if it goes down further, but that would depend upon the increase in supply of oil in different parts of the world after the opening of the Strait of Hormuz and the removal of blockade by both Iran and United States of America. There's also an additional incentive for the oil price to come down under the renewed strength of US dollar and other currencies because of the hawkish stance maintained by all the central banks around the world. Therefore, It'll be interesting to wait and watch the movement of oil during the forthcoming weeks to see if it drops quickly to the pre-Iran US war levels, which were below 65.00, or whether it meanders around the 70 area and takes its own time to come down, or whether it reverses back to its immediate high at 85. So next week is going to be a very crucial week for oil to see if there are any more supplies being created or if there is any new demand coming into play. We shall not be talking about any other asset class today or any other charts because the market is still under the process of assimilating all the information from the announcement of the peace deal between United States of America and Iran, and also the hawkish stance from various central banks around the world. Traders and investors, as we spoke during the introductory part of the video presentation, we shall explore the versatility of option strategies in different kinds of environment. Since the time that we started talking about all kinds of option strategies, we've been impressing upon three different kinds of factors that influence most of the option strategies, and these are the factors that could lead to a trade being profitable or a trade going into a loss. These factors are: number one, time decay; number two, implied volatility of the market; and third one, and the most important one, which is the direction of the market, which is beyond the control of any trader or investor who is trying to take a profit out of the market. Therefore, what we do is we first go into a trade with a speculation of the direction. That's the first part. And then we've got two factors which we can handle to a certain extent. The first one being the time decay. When we look at the time decay, we try to use it in our favor by going on a short if we want the trade to close as soon as possible, and if the time decay is against us, what we do is we try to go into a trade by going long on an option and try to get the longest expiration period that we can, so that the trade finally works to our advantage. Thus, the versatility of the option strategies can be explored in multiple ways, and we have to structure the trade accordingly. Traders and investors, we've been talking about all kinds of factors, and we've just talked about time decay as the first factor that we can handle. The second one that we can handle to a certain extent is the implied volatility of the market. The implied volatility of the market totally depends upon the factors that are influencing the decision of the traders and investors in a market at a given time. If the traders decide to go risk averse, they start selling, and if the investors and traders go into a risk on mood, then they start buying. And depending upon the impetus of the selling and buying reaction from the traders, or in other words, depending upon the number of sell or buy orders, the market volatility changes within no time, depending upon the factors that have influenced the market. Therefore, when we go into an option strategy thinking that the implied volatility is going to be high or low, it doesn't take a very long time for the market to change its direction and a drop or increase in the implied volatility in the market. And in order to do a correction of the trade in which we have entered, we bring in a second leg which is called the offset, and the offset decides or helps to reduce the risk or cut the losses from the trade without actually participating in the profitability of the trade that we have gone into. The third and the most important factor that influences a trade is the direction of the market. Direction plays an extremely important role in the life of a trader, and this influences all kinds of trades, whether it's an option trade, whether it's futures, whether it's stocks, whether it's real estate, whether it's any asset class. Depending upon the direction in which the market moves, the trader or the investor decides to take a position in the market so that he can make a bit of profit. And depending upon how strong is the momentum of the direction or how strong is the trend, the profitability of the trade depends upon the direction and the magnitude or the momentum strength. If the market is making higher lows after higher lows after higher lows, then we say that we are in an uptrend. And if the market is making lower highs after lower highs after lower highs, we say that we are in a downtrend. If the market is range bound, or which means that if the upper and lower limits of the movement of the market is established on the short term or on the medium term, then we say that the market is moving sideways between its upper and lower boundaries. Now, for an option trader, the direction of the market plays a role for him to select the option strategy that he wants to get into. And by any chance, if he's proven wrong by the market in his direction, then he gets the choice to bring in an offset which limits his losses that could have gone to an infinite value had he not brought in this offset leg for the trade. Thus, there is the anchor unit which is driving the profitability of the trade, and there is the offset unit which is restricting or limiting the risk borne by the trade should the direction go in an opposite way to that predicted by the trader or the investor. We shall now talk about the single option trading strategies or the naked option trading strategies. In these strategies, we've just got one option position, and that could be long or short on a call or put option. Now, as compared to other trades where we've got to buy or sell an asset depending upon the market being bearish or bullish, we go into a position and expect the market to continue going out or going against us with a stop loss to prevent our losses and a target to give us a profit. But in case of options, we need to consider a second factor, which is implied volatility of the asset or the market in which we are trying to enter. If the implied volatility is high and it is expected to explode or at least remain high in the near to medium term, then we go long on a call option. Depending upon how the market plays out, we either reach our target at the soonest possible time if the market is explosive, or we could take a bit of time for the market to meander and then slowly move or reach our target. But we do not expect the market volatility to go down or the direction to change and go against us. Thus, the long call option depends upon the implied volatility to be high and the direction in the upward side. The third factor is the time decay, which is against the trader. Therefore, he tries to get into a quarterly option expiring at least 2 months or 3 months later, or if he is getting into a monthly option, then he would rather get into the back month option rather than the first or the front month option, so that the expiry is at least a month and a half later, and his trade gets enough time to reach its target. We shall now talk about the underlying being bearish, or the market in which the trader or the investor wants to take a position being bearish. As we all know, when we talk about bearish markets, we are talking about a greater number of sellers in the market as compared to buyers, or the direction of movement of the market is downward, or the market is in a downward trend. If we were to take a direct position on the underlying, then the trader or the investor would take a short on the asset class with a stop loss on top, so that if the market direction reverses, he gets stopped out with the minimal loss that he incurs, or otherwise he has got a target below the entry position where he expects the market to reverse in direction after filling his target position or after hitting his target position. But in case of an option trade, we also look at the implied volatility of the market, which is expected to be high in these circumstances, and the trader expects the implied volatility to continue to be high, so that the explosive move of the market fills in his target position at the soonest, or at least even if it moves slow, it can fill his position up in the downward direction. And once again, the trader would like to have as much of time as possible in his hands for the trade to successfully end up profitable in his favor. And to do that, he chooses either a 3 monthly or a 6 monthly or a long-term option with a long expiry day, or in case of monthly option trades, he would prefer to go into a back month option rather than a front month option, so that he has got enough time for the trade to reach its desired target. The third of the option or the single option trading strategy that we're going to talk about is going to be in an environment where the direction of the market is neutral to slightly bullish. In such situations, it's very difficult to enter into a direct trade on the underlying, as we are not very confident of the direction in which the price of the underlying is going to move, or whether it's going to break out of the range, or whether it's going to stay within the range in which it is traded. Therefore, we decide to go on an option trade, since we think that the direction is going to stay neutral, or it's slightly bullish but it's not going to come down at any time during the life of the trade that we're going to enter. So the trade that we enter is called a bull put strategy, and we sell an OTM option. It could be a 1 or a 2 OTM, and we expect the underlying price to stay above the strike price at all times. the time decay in this particular trade is in our favor, as we wish or we want the trade to come to an end at the soonest, so that the option expires worthless and you get to retain the premium collected from the sell of the put option. Thus, the bull put strategy is good when the implied volatility of the market is low and the direction of the market is neutral to slightly bullish. We now come to the last of the single option trading strategies, where once again the anchor is the profit driving unit and we do not have any other offset units. In this particular situation, we see that the market is neutral to slightly bearish when the trader or the investor is in two minds to go into a direct trade on the underlying, as he doesn't know if the market is going to remain range bound or whether it's going to break out to the lower side or the downward side. Therefore, the trader or the investor decides to go into a bear call option trade where he sells a call option at an OTM. It could be a 1 OTM or a 2 OTM, and the trader expects the market price to always stay below the strike price of the chosen option trade. Here, once again, the trader or the investor would like the trade to come to an end at the quickest possible time. So the time decay is in his favor, and he chooses to enter into a weekly option trade or a monthly option trade, which could be the front month option, but no later than that, because if one gives enough of time for the trade to change its direction or the implied volatility to go up, then the trade could go against the trader or the investor in or against the intended direction of the trade. Therefore, the best thing is to go for a quick closing option like a weekly or a front month option and allow the trade to expire worthless with the price or the underlying price staying below the strike price at all times. We now shall talk about introducing an offset unit into a single option trade strategy that we've spoken about. We've spoken about 4 different single option trade strategies, but all of these strategies could work if everything works according to our expectation of the market at the beginning of the trade. But what if there is a change in the direction of the market? What if there is a change in the implied volatility of the market? And what if there is a complete change in both the direction as well as implied volatility of the market? So in such situations, the trader is going to incur a loss, and if he doesn't protect himself against the losses, then if he's gone long, then his loss would be limited to the price of the premium that he has paid. But if he's gone short on either of the 2 strategies that we talked about, number 1, the bull put or the bear call strategy, where he's selling a call option or selling a put option. In either of the 2 cases, if the direction changes or if the implied volatility of the market changes, he is going to incur a loss to an infinite value. Therefore, in order to restrict or limit his losses, he brings in another position on the same underlying with the same expiry date, and this is going to be going long on an OTM put option, which is a deeper OTM, which is below the original OTM price at which he had sold the put option. Therefore, now his losses get restricted by the difference between the strike price less the net premium that he has received from getting into a short OTM put and a long deeper OTM put. This is called a bull put spread, and the strategy is very helpful in restricting the losses from a bull put option strategy. Having talked about the introduction of an offset unit into a single option trade strategy, one needs to know that the second unit that comes in to the trade in an option trading strategy need not be the offset unit at all times. The second unit as well could be a profit driving leg, and then we do not have any offsets in this particular trade to restrict the losses occurring from the change in implied volatility in the market or change in direction of the trade. Say for an example, we take a strangle, a short strangle where we sell an OTM call option and we sell an OTM put option at the same time. Now both these units are profit driving units for the trade because we collect a premium while selling the OTM call and we collect a premium while selling the OTM put. So both the units contribute to the profitability of the trade. Now if the implied volatility of the market or the asset that we're talking about goes high, and if there is a price swing in either direction, then we head into a loss making position, whether the price moves up, which is against the call option that we have sold, or if the price goes down below the strike price of the put option that we have sold. So in both these situations, we could end up with an infinite loss. So in order to restrict the losses from the change in implied volatility of the market or change or a sudden swing of the price in either direction, we bring in two long positions which are going to be deeper OTM units. The first one being the long deeper OTM call option, and the second one is the long deeper OTM put option. This is the iron condor that we talked last or week before last, and one can also say that this is a combination of a bull put strategy with that of a bear call strategy. But whatever we call it, whatever the name of the strategy is, this is safer than the simple short strangle which has got no control over the losses, if any, that occur with change in implied volatility in the market or change in direction. We shall be exploring some more of these in our next video presentation, where we shall look at bringing in offset units to the single-legged or the two-legged strategies and prevent losses or restrict the risk from the trade. Ladies and gents, traders and investors, we now come to the conclusion of our video presentation about the versatility of option trading strategies. We saw that the trading strategies can be improved upon, or the losses from the option trading strategies could be reduced by the inclusion of an offset unit in today's video. We shall be exploring more of these combinations or the way that the option strategies can be combined to make bespoke strategies according to the choices of the trader investor and according to the environmental conditions of the market. We hope that we found our video presentation informative enough and exciting enough for you to come back and watch all our videos, and we request you to please hit the bell icon and watch all our videos and subscribe to our channel Polo Vega. You can also visit us at our website www.polovega.com or get in touch with us through our Twitter handle at Polo Vega. We thank you for watching our video, and please like, share and subscribe to our channel Polo Vega. We wish you all the very best, and we look forward to see you at our next video presentation next week.